Hey there, fellow finance enthusiasts. Hugh Hendry has made a statement that the global economy is in an era of errors. Is he right? Well, we will find out why he thinks so. This is the moment where knowledge intertwines with excitement, where education seamlessly merges with entertainment, and where understanding embraces pure exhilaration. Without further ado, let's delve in.
And here we go.
As deficit countries, we buy their goods and services. They have amassed an immense surplus of capacity in China et al., but in return, they buy our financial assets. They don't buy our goods and services. And so we're left with this predicament of profound asset price inflation, but disinflation, deflation in the real compensation for the real folk. And the central bankers don't get that, and I'm afraid they're compounding it, and it feels like class warfare.
In the video, we see how Hendry's analysis highlight the global economy and underscore the prevailing era of policy errors, which bear significant consequences for the United States economy. His insights shed light on how these errors have impacted the U.S. economy, leading to a potential crash and reinforcing the relevance of the topic. An area of concern lies in the rise of China as a major global player, particularly in terms of industrialization and export prowess. While China's economic growth has been remarkable, their capital account remains relatively closed, restricting the flow of financial assets. As a result, the U.S. and other deficit countries have become heavily reliant on importing Chinese goods and services, accumulating substantial financial liabilities in the process. This dependence on China has created a delicate situation for the U.S. economy. On the one hand, soaring asset prices suggest apparent economic prosperity. However, the reality is that real compensation for the general population has stagnated, exacerbating income inequality and fueling a sense of economic disparity. This growing divide between the wealthy and the rest of society intensifies class warfare dynamics, which have long-term implications for social and economic stability. One concerning aspect is the apparent disconnect between central bankers and policymakers from the realities faced by ordinary citizens. Their decisions and actions, akin to a chef over-seasoning an already salty dish, further contribute to the existing problems within the economy. This detachment from the real-world implications of their policies adds to the overall fragility of the U.S. economy. Hugh Hendry's analysis serves as a crucial reminder of the urgent need for course correction in the face of these policy errors. Failure to address these issues increases the vulnerability of the U.S. economy to a potential crash. The interconnectedness of global economies and the repercussions of misguided policies emphasize the significance of Hendry's assessment, which argues that the global economy is currently immersed in an era of errors.
I'm in danger!
In conclusion, the impact of these policy errors on the U.S. economy cannot be understated. Hendry's insights highlight the consequences of relying heavily on China, the increasing wealth disparity, and the detachment of policymakers from the real economy. This connection to the topic demonstrates the pressing need to address these issues to avert a potential crash and strive for a more harmonious and sustainable economic landscape.
There are three components to GDP growth. Population growth, and I'm afraid we're not having enough babies, okay?
Yep.
Productivity growth, which is really dependent upon investment, and we're not investing because why would you with this lake of capacity in the East? And so you're reliant upon debt growth. Now, it's a fragile equilibrium as long as you operate a kind of zero interest rate policy that you make the cost of carrying that debt very low.
We need higher wages. Let me break it down for you. GDP growth relies on three things: population growth, productivity growth, and investment. Moreover, we'll examine the need for reassessment and propose possible courses of action to mitigate the risks that lie ahead. He emphasizes that higher wages play a crucial role in driving GDP growth. However, the U.S. economy is hindered by declining population growth caused by decreasing birth rates. This trend poses challenges to economic expansion and affects sectors like housing, consumer spending, and labor force dynamics. Hendry emphasizes the crucial link between productivity growth and investment. However, the U.S. economy lacks sufficient investment, leading to a slowdown in productivity. To compensate, the U.S. relies on increasing debt, which poses risks if interest rates rise. Hendry calls for a revaluation of interest rate policies to avoid severe consequences for the vulnerable economy.
I would suggest that the US government, as a form of flattery, turns around to their Chinese counterparts and says, you know what, it's hats off to you. It's been a success. You have risen. In the last 30 years, China's gone from the GDP of Turkey today to the size of continental Europe. And I would propose the US close its capital account. Now, that would not be without consequences, severe and bad consequences. Asset prices would shrink. And guess what? The power brokers who control Washington are Wall Street, and they don't want it. And so we have this profound, grotesque Gini coefficient, which just gets worse. The rich get richer and richer, and asset prices elevate to levels.
In his thought-provoking analysis, Hugh Hendry highlights the prevailing era of errors in the global economy. This article focuses on the impact of these errors on the U.S. economy, particularly in relation to the U.S. government, and explores the reasons behind this turbulent era. Hendry challenges the status quo, proposing unconventional solutions that may have significant consequences. The U.S. capital account and asset prices. Hendry suggests a radical measure for the U.S. government to acknowledge and appreciate the remarkable economic rise of China, closing the U.S. capital account. Although this proposal seems drastic, Hendry emphasizes the severe consequences it would entail. Asset prices would shrink, resulting in dissatisfaction among the power brokers who control Washington, namely Wall Street. This scenario accentuates the widening wealth gap as the rich become richer while asset prices soar. Implications of a financial wall. Moving forward, Hendry explores the implications of erecting a financial wall between China and the United States. This idea could lead to interesting outcomes, such as increased purchases of goods and services from the U.S. by China, potentially appreciating their currency and enriching Chinese citizens. Paradoxically, Hendry also highlights the possibility of Chinese currency devaluation, challenging conventional economic logic. Structurally higher inflation and collapsed compensation. Hendry questions whether the implementation of a financial firewall will come to fruition. He suggests that such a scenario could lead to a world with structurally higher inflation and inflated asset prices. In his view, central banks are powerless to rectify this situation, requiring coordinated actions at the government level. Hendry points out the surplus capacity in Eastern mercantilist nations, which contributes to the decline in real compensation for Western households. Alternative investments, gold and Bitcoin. In the midst of these discussions, Hendry introduces gold and Bitcoin as alternative investment options. He presents the mind-boggling notion that if gold were to triple in value, it would surpass the size of all U.S. stocks combined. Moreover, he acknowledges the growing presence of Bitcoin in the world of asset allocation. In conclusion, Hendry's unconventional perspectives expose global economic errors, their substantial impact on the U.S. economy, specifically the government's role, is evident. Hendry's ideas ignite discussions, revealing the value of diverse viewpoints. Exploring solutions becomes vital to addressing these errors and mitigating their effects on the U.S. and global economies.
$500 trillion, it would be half the size of Apple. So I think, yeah, I'm kind of greedy, and I'd have some of that. We're seeing extraordinary things. We're seeing, crypto being cleaned, crypto being eliminated. Bitcoin is not crypto, it's a commodity, yeah? And we've seen this remarkable development in the last few weeks where you've seen BlackRock and Fidelity apply for an ETF, okay? and it's likely to succeed. These are the ultimate insiders. You can buy Bitcoin today at a 40% discount to the prevailing price by buying the Greystone Trust in the US. It's a closed-end fund applying to be an ETF. It will become an ETF. So there's an opportunity.
Hendry's audacious ideas and daring proposals infused the realm of economic discourse with a breath of fresh air, captivating our curiosity and sparking vibrant debates. Fearlessly venturing into uncharted territories, he illuminates the shadows lurking within our financial systems, shaking the foundations upon which the global economy rests. In this era of errors, Hendry's voice emerges as a guiding beacon, urging us to scrutinize the choices made by governments and institutions that have led us astray. As you go about your day, remember to stay informed and critically evaluate the economic landscape. By doing so, you can navigate through the challenges and seize the opportunities that arise. What do you think about this topic? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe to this channel. I'll see you in the next video.